Imagine you have Rs 1 lakh in your trading account. You see a stock that looks perfect. The chart is strong. The trend is bullish. The news is positive. The confidence is high. So you decide to put Rs 80,000 or even Rs 1 lakh into that one trade. At first, everything looks fine. But then the market suddenly moves against you. The stock falls 10%. Now you are down Rs 10,000. You try to recover the loss. You take another trade. That trade also goes wrong. Then another. And slowly your Rs 1 lakh account starts shrinking. This is where one of the most important rules in trading comes in. Never allow one trade to damage your entire trading capital. That is why traders often talk about the 1% to 5% risk rule. But there is an important point that many beginners misunderstand. The rule is not simply invest only 1% to 5% of your money in one trade. The more important question is how much of my total capital am I actually willing to lose if this trade goes wrong? And that difference can completely change the way you manage your money. In this video, we will understand risk management from the ground up. We will look at real numbers. We will see what happens after a series of losing trades. We will understand position sizing. And most importantly, you will learn why protecting your capital is often more important than finding the next winning trade. What is risk management in trading? Let's start with the simplest definition. Risk management is the process of controlling how much money you can lose before you even enter a trade. Think about it like driving a car. You cannot control every vehicle on the road. You cannot control the weather. You cannot control whether another driver makes a mistake. But you can control your speed. You can wear a seat belt. You can maintain your brakes. And you can avoid taking unnecessary risks. Trading is very similar. You cannot control the market. You cannot control the next candle. You cannot control breaking news. You cannot control whether a stock suddenly gaps up or down. But you can control your position size, your stop loss, your maximum loss, your number of trades, and the amount of capital you expose to risk. That is risk management. The first rule: protect your trading capital. Your trading capital is your business capital. If you have Rs 1 lakh, that Rs 1 lakh is not just a number on a screen. It is the money that gives you the opportunity to trade tomorrow. Once a large portion of that capital disappears, recovering becomes much harder. For example, suppose you start with Rs 1 lakh. You lose 10%. Now you have Rs 90,000. To get back to Rs 1 lakh, you don't need a 10% return. You actually need approximately 11.1%. Now imagine you lose 30%. Your Rs 1 lakh becomes Rs 70,000. To recover from Rs 70,000 back to Rs 1 lakh, you need a return of about 42.9%. And if you lose 50%, your Rs 1 lakh becomes Rs 50,000. Now you need a 100% return just to get back to where you started. This is why large losses are so dangerous. The mathematics of recovery becomes increasingly difficult as your account gets smaller. Why do traders use the 1% rule? Let's say your trading capital is Rs 1 lakh. If you follow a 1% risk rule, your maximum planned loss on one trade would be Rs 1,000. That means if the trade fails and your stop loss is executed as planned, your loss should ideally be around Rs 1,000 or less before considering slippage, brokerage, taxes, and other costs. Now imagine you take 10 losing trades. That's painful. But your account would still be around Rs 90,000 before costs, and assuming each loss was exactly Rs 1,000, you haven't destroyed your account. You still have capital. You still have opportunities. You can continue learning. And most importantly, you haven't entered the psychological state where every next trade feels like a desperate attempt to recover your previous loss. But what does 1% to 5% actually mean? This is where things become extremely important. Suppose you have Rs 1 lakh. Someone says buy risk only 1%. Does that mean you can buy only Rs 1,000 worth of shares? Not necessarily. This is a common misunderstanding. Your position size and your risk amount are two different things. Let's understand this with an example. You have Rs 1 lakh. You decide that you are willing to risk 1%, which is Rs 1,000. You want to buy a stock at Rs 500. Your stop loss is Rs 480. So your risk per share is Rs 500 minus Rs 480. That equals Rs 20 per share. Your maximum planned risk is Rs 1,000. So you could theoretically take Rs 1,000 divided by Rs 20. That's 50 shares. The total position value would be 50 multiplied by Rs 500. That's Rs 25,000. Notice what happened. You invested Rs 25,000 in the position. That's 25% of your account. But your planned loss at the stop loss is only Rs 1,000 or 1% of your total capital. This is why saying only invest 1% of your capital can sometimes be misleading. The more useful question is, how much can I lose if my stop loss is hit? The position sizing formula. Here is a simple formula every trader should understand. Position size equals maximum risk amount, risk per share. Let's use the same example. The total capital Rs lakh, maximum risk 1%, risk amount Rs 1000, entry price Rs 500, stop loss Rs 480, risk per share Rs 20, position size Rs 1000, Rs 20. That gives you 50 shares. This approach allows you to control your risk before entering the trade. And that is much more powerful than simply saying, I will buy Rs 20,000 worth of this stock. Because two different stocks can have completely different volatility and stop loss distances. Why 5% risk can be extremely aggressive. Now let's talk about the upper end of the range. 5%. If your account is Rs 1 lakh, 5% equals Rs 5,000. One losing trade costs Rs 5,000. That may sound manageable, but what happens after several consecutive losses? 5 losing trades at 5%. Each would mean approximately Rs 25,000 lost if each loss is calculated as 5% of the original capital. Your account could fall to around Rs 75,000, and now you need more than a 33% gain from Rs 5,000 to get back to Rs 1 lakh. This is why a 5% risk per trade is generally considered aggressive for many traders. For beginners, risking 5% of total capital on every trade can create significant drawdown and psychological pressure. A smaller risk level can provide much more room to survive a losing streak. The real enemy is not one losing trade. A single losing trade is normal. Even highly experienced traders have losing trades. The real danger is a series of losses combined with oversized positions. Let's imagine two traders. Trader A risks 1% per trade. Trader B risks 5% per trade. Both experience 10 consecutive losing trades. Trader A experiences a much smaller drawdown. Trader B experiences a dramatically larger decline. And here's the important part. The market doesn't care whether you are trying to recover your money. Your next trade has no obligation to make up for your previous loss. This is where many beginners make a dangerous mistake. They lose Rs 5,000. Then they think, I need to make Rs 5,000 back today. So they increase their position. Then they lose another Rs 8,000. Now they think, Achin, I need to recover Rs 13,000. The position becomes even larger. This creates a cycle. Loss leads to emotional trading. Emotional trading leads to bigger positions. Bigger positions lead to bigger losses. And bigger losses create even more emotional pressure. This is how a manageable trading loss can turn into a serious financial problem. Never trade with the goal of recovering a loss quickly. Let's say you lose Rs 3,000 today. There are two possible reactions. Reaction number 1, I lost Rs 3,000. I need to make Rs 3,000 before the market closes. This is dangerous. Reaction number 2, my trading plan produced a Rs 3,000 loss. I will review what happened and wait for the next valid setup. This is disciplined. The goal of a professional approach is not to win every trade. The goal is to create a process where small losses stay small. Winning trades are allowed to develop, and one bad trade cannot destroy the account. What happens if you risk 1% per trade? Let's take a hypothetical example. Starting capital Rs 1 lakh. Risk per trade 1%. Now suppose you have 5 losing trades, then 5 more losing trades. 10 losses in a row sounds terrible, but the account is still far from being destroyed. If the risk is calculated as 1% of the current account balance each time, the account after 10 consecutive 1% losses would be approximately Rs 438. That is roughly a 9.6% decline. Still painful, but recoverable. Now compare that with repeatedly risking 5% of the current account. After 10 consecutive 5% losses, the account would be approximately Rs 59,874. That's about a 40% drawdown. Now the recovery challenge becomes much larger. This is the power of controlling risk. The bigger the loss, the harder the recovery. Let's look at the recovery mathematics. If your account falls by 10%, you need about 11.1% to recover. If it falls by 20%, you need 25%. If it falls by 30%, you need about 42.9%. If it falls by 40%, you need about 67%. And if your account falls by 50%, you need 100% gain. This is why experienced traders often focus more on avoiding catastrophic losses than on chasing spectacular profits. A 50% loss is not simply the opposite of a 50% gain. The mathematics doesn't work that way. Risk to reward ratio also matters. Risk management doesn't stop at position sizing. You should also think about the relationship between your potential loss and potential profit. This is called the risk to reward ratio. Suppose you are risking Rs 1000. If your potential target is Rs 2000, your risk to reward ratio is approximately 1 to 2. In simple terms, you are risking Rs 1 to potentially make Rs 2. Now imagine you have a strategy that wins only 40% of the time. At first, 40% may sound terrible. But if your winners are significantly larger than your losers, the strategy could still potentially be profitable over a large number of trades. This is why you should not judge a trading strategy only by its win rate. A trader who wins 70% of trades can still lose money if the losing trades are huge. And a trader who wins only 40% of trades can potentially make money if losses are controlled and winners are larger. Example: 2 traders, 2 different results. Let's compare 2 hypothetical traders. Trader A wins 7 out of 10 trades. Sounds amazing, right? But suppose every winning trade makes Rs 500 and every losing trade loses Rs 2000. 7 winning trades produce Rs 3500. 3 losing trades produce the Rs 6000 loss. Overall result, Rs 2500 loss. Now trader B wins only 4 out of 10 trades. Each winning trade makes Rs 2000. Each losing trade loses Rs 1000. 4 winners, Rs 8000. 6 losers, Rs 6000. Overall result, Rs 2000 profit. This example shows why risk management matters so much. Trading isn't simply about being right more often. It's about controlling the size of your mistakes. Never put your entire account at risk on one idea. One of the biggest mistakes beginners make is concentration. They see a stock they love. Maybe they believe the company is excellent. Maybe they believe the stock is undervalued. Maybe a famous investor owns it. Maybe there is breaking news. And then they put most of their capital into that one position. But remember, a good company is not automatically a good trade. The market can behave differently from your expectations. A stock can fall because of earnings. A sector can suddenly weaken. A global event can affect the market. A gap down can happen overnight. And sometimes the market simply does something nobody expected. Risk management exists because uncertainty exists. What about stop loss orders? A stop loss can help define the maximum planned loss on a trade. But a stop loss is not a magical guarantee. In fast-moving markets, gaps, slippage, or liquidity issues can cause the actual exit price to differ from the intended stop price. That's why your position size should not be based on the assumption that the stop loss will always execute perfectly. Give yourself a safety margin. And remember that leverage can magnify both gains and losses. The higher the leverage, the more important risk control becomes. Why beginners should usually start smaller? When you are new to trading, you don't yet know how you will react emotionally to losses. You might think, I will easily follow my stop loss. But when you actually see Rs 5000 disappearing from your account in a few minutes, your psychology can change. You may move the stop loss. You may average down. You may revenge trade. You may enter another position without a setup. This is why small risk is not only about protecting your money. It also protects your decision-making ability. If a loss is small enough that you can remain calm, you're more likely to follow your trading plan. The 1% rule is a guideline, not a universal law. There is no magical number that works for every trader. Some traders may choose to risk less than 1%. Others may use different risk limits depending on their strategy, volatility, account size, and experience. The important principle is define your maximum acceptable loss before entering the trade. Don't decide your risk after the trade starts going against you. That's when emotions take over. Your risk should be planned when you are calm, not when you are watching a red candle move rapidly against your position. A simple risk management system for beginners. If you are a beginner, you can create a simple framework. Step number 1. Know your total trading capital. For example, Rs 1 lakh. Step number 2. Choose a maximum risk percentage. For example, 1%. That gives you a maximum planned loss of Rs 1000. Step number 3. Identify your entry price. Suppose Rs 500. Step number 4. Identify your stop loss. Suppose Rs 480. Step number 5. Calculate your risk per share. Rs 20. Step number 6. Calculate your position size. RS1000 divided by RS20 equals 50 shares. Step number 7. Check whether the trade still makes sense after considering brokerage, taxes, slippage, and other costs. If the position size is too large for your strategy or comfort level, reduce it. If the setup doesn't offer a reasonable potential reward compared with the risk, skip the trade. And this final step is extremely important. You don't have to take every trade. Sometimes the best trade is no trade. What if you have multiple trades open? This is another important part of risk management. Suppose you have RS1 lakh, you risk 1% on one trade. That's RS1000. Then you open 5 different trades. If all 5 positions can lose RS1000 each, your total open risk could be around RS5000. That's 5% of your account. Now imagine all 5 positions are in the same sector. Suddenly you may have much more concentration than you realize. For example, holding 5 different banking stocks does not necessarily mean you have 5 completely independent bets. A major event affecting the banking sector could impact all 5 positions at the same time. So risk management should consider portfolio-level exposure, not just individual trades. Don't confuse trading with investing. Another important distinction. Risk management for short-term trading and long-term investing can look very different. A trader may use a technical stop loss and calculate position size based on a predefined risk. A long-term investor may focus more on valuation, business quality, diversification, asset allocation, and investment horizon. So don't blindly copy a trading rule and apply it to every investment decision. The correct risk framework depends on what you are doing. The most dangerous sentence in trading. One sentence causes enormous damage. This trade cannot go wrong. The moment you believe that, you stop thinking about risk. There is no trade with zero risk. Not in stocks, not in options, not in futures, not in crypto, not in forex, not anywhere. The market is uncertain by nature. Your job isn't to eliminate uncertainty. Your job is to survive it. What should you do after a losing trade? Here's a simple process. First, accept the loss. Second, don't immediately increase your position size. Third, don't revenge trade. Fourth, review whether you followed your plan. Ask yourself, did I enter at the planned level? Did I use the correct position size? Did I respect my stop loss? Was the trade based on my strategy? Did I break any rules? If you followed your system and still lost money, remember, a good trade can lose money and a bad trade can sometimes make money. One trade doesn't define your strategy. Your process over many trades matters much more. Your goal is survival. First, think about trading like a marathon. You don't win a marathon by sprinting for 5 minutes and collapsing. You win by managing your energy over the entire distance. Trading is similar. You don't need to make huge profits every day. You need to remain in the game long enough for your strategy to work. That means control your losses. Control your position size. Avoid excessive leverage. Don't revenge trade. Don't overtrade. Don't put your entire account behind one idea. And never risk money that you cannot afford to lose. A practical example. With RS5 lakh capital, let's make the example bigger. Suppose your total trading capital is RS5 lakh. If you choose a 1% maximum risk per trade, 1% of RS5 lakh equals RS5000. Now suppose you want to buy a stock at RS1000. Your stop loss is RS950. Your risk per share is RS50. Your maximum risk is RS5000. So your position size would be RS5000 divided by RS50. That's 100 shares. The total position value would be RS1 lakh. So you are controlling a RS1 lakh position while your planned loss is RS5000. Again, the important number isn't simply the RS1 lakh position. The important number is the RS5000 maximum planned risk. This is the foundation of position sizing. What if the stop loss is very wide? Now imagine another trade. Entry, RS1000. Stop loss, RS900. Risk per share, RS100. Your maximum risk is still RS5000. So your position size becomes RS5000 divided by RS100. That's only 50 shares. Position value RS50,000. Notice what happened. When the stop loss became wider, the position became smaller. This is exactly what disciplined position sizing is supposed to do. Higher risk per share means smaller position size. Lower risk per share can allow a larger position size. The goal is to keep your total planned risk within your predefined limit. Don't increase your risk. Just because you are confident, confidence is useful. Overconfidence is dangerous. You may have 5 winning trades in a row. Then you think, Ancha, My strategy is working perfectly. So you increase your risk from 1% to 5%. And the next trade loses. Then another loses. Suddenly, the confidence created by 5 wins disappears in just a few trades. The market doesn't know that you won 5 trades before. Every new trade is a new probability. That's why risk rules should remain consistent. What about options and leverage? This becomes even more important when dealing with leveraged instruments such as futures or options. A relatively small market movement can produce a much larger percentage change in your trading capital. This can create both fast profits and fast losses. Beginners should be particularly careful about using leverage simply because their broker allows it. Broker-approved leverage is not the same thing as safe leverage. Just because you can take a large position doesn't mean you should. Your position size should be based on your risk plan, not on the maximum amount your broker allows you to trade. The golden rule: risk first, profit second. Before entering a trade, don't start with, how much can I make? Start with, how much can I lose? Then ask, where is my trade invalidated? Where will I exit if I'm wrong? How many shares or contracts should I take? Does the potential reward justify the risk? And finally, can I emotionally handle this loss? If the answer is no, your position may be too large. 7. Risk management rules every trader should remember. Let's quickly summarize the key rules. Rule number 1. Never risk a large portion of your capital on one trade. Rule number 2. Think in terms of risk amount, not just position value. Rule number 3. Calculate position size before entering the trade. Rule number 4. Define your stop loss or invalidation level before entering whenever your strategy uses one. Rule number 5. Don't increase position size to recover previous losses. Rule number 6. Consider your total portfolio exposure when you have multiple trades. Rule number 7. Protect your capital so you can continue trading tomorrow. Final thoughts. Trading is not a game where the person who makes the biggest profit in one day automatically wins. The real challenge is consistency. You can have the best technical setup. You can have excellent market knowledge. You can use sophisticated indicators. You can study charts for hours. But if your position sizing is poor, one bad trade can undo weeks or months of progress. That's why risk management should come before profit targets. Before asking, how much can I make? Ask, how much am I willing to lose? Before asking, should I buy more? Ask, what happens if the market moves against me? And before entering any trade, remember one simple principle. Your first job as a trader is not to make money. Your first job is to protect the capital that allows you to stay in the game. Because if you protect your capital, you preserve your opportunities. And if you preserve your opportunities, you give your strategy the time it needs to work. Important disclaimer. This video is for educational and informational purposes only. It is not financial investment, trading, or tax advice. The 1% to 5% range discussed in this video is a general risk management concept, not a universal rule or a guaranteed safe level for every trader. Actual risk depends on your financial situation, trading strategy, experience, market conditions, leverage, instrument, liquidity, and other factors. Trading stocks, futures, options, forex, cryptocurrencies, and other financial instruments can involve substantial risk, including the possible loss of your capital. Always do your own research and consider consulting a qualified financial professional before making investment or trading decisions. Never trade with money you cannot afford to lose.